In this video, what I want to delve into is one very important aspect of trading strategy, and that aspect is the balance between wins and losses. What's the right percentage that the most successful managers in the world have, that you should have when it comes to wins and losses? And when you evaluate your own strategies or the strategies I'm going to give you, what is the correct proportion of wins to losses in all of that? That's what we're going to cover here. Now, let's look at it in one simple way. If the markets were random, then you would be right 50% of the time. And if you're right less than 50% of the time, well, then just do the opposite of what you're doing. Okay? Another way of looking at this is God is only right 100% of the time. Therefore, we would expect any trading strategy to be correct somewhere between 50 to 100% of the time, wouldn't we? 50% is just a coin toss, so we'd expect to be better than that. And we don't expect to be as good as God himself. So we're going to be right maybe 6 times out of 10 or 7. That's where it's going to lie. Okay? So that's one way to evaluate the win-loss ratio. How often do you win compared to how often do you lose? However, and this is where private investors get confused, it's not about how often you win and how often you lose. It's actually about how much you make when you win and how much you lose when you lose. Because it's very easy to be right 100% of the time. You just don't ever exit your losing trades. But the problem with that is you'll end up like an iceberg, having a lot of losing trades which are open and never closed, and you only close your winning trades. So it looks like you're right all the time, but you're not. So it's not actually about win-loss ratios. A professional trader understands that in actual fact, rather than being about win-loss ratios, it's about how much you win when you win, how much you lose when you lose. Or put another way, it's about making sure you don't lose a lot. How do you therefore keep your losses small? How do you ensure your losses will not be too large? And why is that important anyway? Well, it's for this reason. The reason losses need to be small is because imagine you have a portfolio and you are down 5%. With the money that you've got left, you've got to generate 5.3% on that in order to get back to your original capital. If you were down, for instance, 20%, so it went from 100 to 80, then on 80, you've got to generate a 25% return to get from 80 to 100. Okay, it's simple maths. 25% of 80 is 20. 20 added to 80 brings you back to 100. So do you see how a small drawdown, like 5%, means a bigger amount that you need to gain in order to recover? A drawdown of 40% needs a 66% gain to recover. Do you see how it starts getting bigger and bigger and bigger? Even though the drawdown is only 40%, you need a 66% gain in order to get back to break even. That's why you need to make sure your drawdowns or your losses are small. So again, it's not about how often you win or how often you lose. It's about making sure your losses are small. Simple maths, which professional traders understand, retail investors don't. They think it's all about how often you win, how often you lose. It would be if all your wins and all your losses were the same size, but they're not. Losses have to be small. Here's looking at it another way. Let's talk about preserving profits like a miser. If you had in your system even 5 consecutive losing trades, and let's say you lost 2% on each one, then you'd only be down 10%. But if you risked 10% on every trade and had 5 consecutive losing trades, you'd lose half your capital. That's 50%. You'd need to double your money in order to break even. Do you see why your losses have to be small in order to preserve your profits? So it's not about win-loss ratios as much as it is about preserving profits and keeping losses small. Put yet another way. You have $10,000 to trade with, and you have 100 trials in a game, let's imagine, in which you can win 60% of the time. So it's a bit like trading. 60% of the time you win. If you win the amount of money you bet. So you double your money. If you lose the amount you bet. Okay? In an experiment like this, out of 40 PhDs, only 2 made money. Why? They bet too large a size. What happened is, because they had 100 trials in the game and they wanted to make lots of money, even though they could win 60% of the time, they still ended up losing because they had a string of losing trades. And once they had a string of losing trades, it's very difficult to catch up. All this math is, to us professional traders, hedge fund managers, common knowledge, but to private investors, it simply isn't. That's why the trading strategy I'm going to show you, it's very important that we don't just focus on win-loss ratios, but how to cut our losses short. Let me put it yet another way. Let's say you had total equity, so total capital of $20,000. Let's say you placed $10,000 per trade. If you then did a certain number of trades where you made 20%, then lost 25, then lost 25, then made 5, then lost 30, but you were betting $10,000 per trade, this is what would happen to your overall equity. You'd be down 27.5%. So you'd have to make a heck of a lot of money to break back to even. If you only risked $2,000 per trade and made the same trade, so you made 20%, lost 25, made 5, lost 30, you'd only be down 5.5%. Now picture that. Who's outperformed? They've both done exactly the same trades, had the same money to start off with. The person who's outperformed is the person who bet the smaller sizes. That's critical to success in trading. The smaller sizes mean that if you get a bad patch of trades, you don't have too far to recoup in order to make profits. Got it? Again, let me put this into a more detailed analysis, a very professional analysis. Let's say your risk is 1% of your total trading capital. So on any trade you're wrong, you could only lose 1% of your trading capital. Let us look only at losses and say we get 16 trades in a row wrong. 16 is pretty rare. Your loss is still less than 20%. We have cash to come back the next day. The probability of getting it wrong 16 times in a row, by the way, is worse than a coin toss, which is 50-50. We manage our risk so we're in it for the long haul. It's a marathon, not a sprint, said my mentor David Kite. You can see the account balance, and this is the maths that I've gone through on it. So you can see that if you're risking small amounts of your overall capital, then even if you're wrong a lot, you've got ample money to come back. The biggest mistake private investors make is they get greedy and look at it the other way and say, well, I want to make my riches a lot quicker, so I'm going to bet bigger sizes. That's simply wrong. Risk reward has to be at least 1 to 1.25 in foreign exchange. And the strategy I'm going to show you show that. What does that mean? I'll explain what it means as we go forward. But let me explain why. Imagine, as you can see in the previous one, you made all those losses, but then you had 1% gains for a series of trades, or you had 2% gains because your rewards in your winning trades were double what your losses were in your losing trades. 2% gains take us above our initial capital to close our account at the end of the month, a lot in profit. More interestingly, when we've correctly applied the risk reward, we can still make money even when half the time we have lost and the other half we have won. Do you see, if your risk reward, which is more important than your win-loss ratio, your risk reward is greater than 1, that means your reward, when you win, you'll make more than when you lose. You quickly recoup your money and you do well very, very quickly. And that is what quality trading is about. That is what I'm going to teach you going forward. That is what I'm going to teach you going forward so that you can see how it is that us professional traders trade and succeed in making money by ensuring that what we're doing is limiting the losses, making sure when we win, our rewards are bigger. So when I show you the strategies, I'm going to take you through rewards and risks to ensure that our upside is bigger than our downside and that the maths works. So in a way, it won't even matter what we're trading. It'll be the fact that we're making money either way. winners and losers, this is the difference between them. Winners add to winning positions. They exit losses quickly. They let profits run. The risk is only 1 to 2% of capital per trade. Losers add to losing positions. They exit profits quickly. They let their losses run, and they risk 5 to 10% of their capital on each trade. We'll be going through all of this with actual strategies. The reason I need to show you this beforehand is so we can build up to it. So we can build up to the actual strategy. You understand they are the way they are for this reason. Let's answer some of the questions which routinely come up. Assuming comparable returns, why would professional traders prefer a methodology which has a 30% success rate over one with a 70% one? Here's one answer. I'd characterize the argument a little differently. It is more about the methodology with the 30% hit ratio will be more robust. It will be more armored against losses, since routine losses and aggressive risk control in respect to extended loss periods are already part of the program. The 30% preference is also based on rule of thumb awareness of how profits and hit ratios are typically distributed. In a famous book by The Stock Market Wizards, one of the hedge fund managers, Steve Cohen, puts it this way, that the best traders in the world are sometimes right, over 63%, but many will make money by being right only 30% of the time. Many people assume traders with high win percentage will have considerably stronger profitability. But in actual fact, it doesn't work like that necessarily. The Bear Stearns high-grade structured credit opportunities fund had a positive return for 40 months in a row. Then it blew up. Vic Niederhofer has had more than his fair share of long stretches of net positive returns, followed by repeated blow-ups. It happens all the time. They take all their volatility once. They win 9 times out of 10. They have high wins to loss ratios, but when they lose big. That's what we're going to avoid. And we're going to now, in the next video, talk about how we limit our loss.